just when you thought it couldn't get any worse, tragedy comes again for Boeing.
Alaska Airlines Flight 1282 had just taken off from Portland, Oregon when a section of its cabin ripped
Door
off.
plug on an Alaska flight blew
Door
out,
plug blown out of a Boeing 737.
leaving a hole in the plane.
And this most recent scandal is coming right as the company was beginning to recover from their last tragedy back in 2019, where 2 planes tragically crashed. So it seems that the quality assurance teams and executives working at Boeing haven't been earning their bonuses. It must be nice to get millions in bonuses for creating unsafe aircraft that underperform the market and competitors. Anyway, on January 24th of this year, Alaska Airlines Flight 1282 experienced a total nightmare. Miraculously, no one was injured in that Alaska Airlines flight, but that was the only good news for Boeing.
Alaska Airlines is now grounding its entire fleet of Boeing 737 9
The
MAX
head of the
planes.
aviation giant has said the company must acknowledge its
United
mistake.
Airlines revealing that inspectors have found loose bolts on more.
Boeing's also agreed to allow airlines into its factories and those of a contractor that builds the plane's fuselage.
We as investors follow the news to look for possible opportunities. Overblown bad news that causes a stock to plummet can be a great opportunity to buy a stock, and we can take lessons from Warren Buffett exactly on this. He made one of the best investments of his career on overblown bad news, which we will cover later in this video. But is this a case of overblown news, or is there more at stake here? If there are deep cultural issues inside of Boeing, then this moves from overblown bad news causing a minor setback to a full turnaround story. And full turnaround stories are an entirely different game when it comes to investing. Let's first look at what Mr. Warren Buffett thinks about turnarounds. As you probably know, Buffett's company is Berkshire Hathaway, and it actually started out as a textile company. Buffett began acquiring shares in the early 1960s and eventually became the chairman and CEO by 1964 through an activist campaign. But what you may not know is that he actually saw Berkshire as a turnaround story. He thought that he could restore its textile operations through solid management and disciplined spending, or at the very least, the price at which he bought Berkshire Hathaway was less than the book value or total assets, so he'd be able to chop up and sell the company later for profit. But he does write during that time that he sees the importance that the textile mills had on the local communities, and so he kept at it. So much so that Berkshire continued producing textiles all the way until 1985. However, by his 1979 shareholder letter, it seemed like it became clear that he knew his textile operations were doomed. He writes, "Both our operating and investment experience cause us to conclude that turnarounds seldom turn, and that the same energies and talent are much better employed in a good business purchased at a fair price than in a poor business purchased at a bargain price." You'll hear that quote constantly repeated by Buffett. It's how he originally separated from his original teacher and the father of value investing, Benjamin Graham. And frankly, that's why we don't call ourselves value investors here at Flank. We call ourselves Buffett-style investors. And so you can see that Buffett is clearly not a fan of turnarounds. However, that comes with some caveats. When he does identify a turnaround play, like he did with Fruit of the Loom in the early 2000s, he has this to say.
Fruit of the Loom has, between 40 and 45% of the men's and boys market. It's a product that has a deserved quality image. It's accepted in a big way by very important retailers who were disturbed by things that took place prior to and early in the bankruptcy, but who love the idea of having a product like Fruit of the Loom in their stores, and it's a very low-cost producer of a very basic product. So it fits us very well. It's made to order for us, but it's only made to order with the present management. If we'd had to take on the management that was there for a few years, we wouldn't have bought it for $1. It would have been a disaster, and it was a disaster for a while. But fortunately, it's a little like Geico in the mid-'70s. I mean, Geico was a marvelous company that got mismanaged in a big way for a while. but its fundamental advantages were there throughout the period, and what you had to do was get rid of the mismanagement and get back to the basics.
So he'll engage in a turnaround play, but only if he can take operational control. He bought Fruit of the Loom because he could put his management in place, and he saw that it was a good business fundamentally. We can't do this yet, so we should try to avoid turnarounds wherever possible. However, if you just Googled Buffett and turnarounds, this would be the end of the story. But I really like this stuff, so I've read all of the letters to shareholders. But if you're just starting out, I would wait until you become a little bit more familiar with this stuff before diving into the letters. You'll want to have a basic understanding of accounting as it pertains to investing, so I hold off on reading the letters unless you're already an intermediate investor. Anyway, because I've read the shareholder letters, I have a bit more context to Buffett's investment ideology than other sources do. And I think that in Buffett's mind, he actually separates turnarounds from overblown short-term news causing a setback. And here's what I think the difference between the two are. I think in a turnaround situation, it implies that it's either a bad business by economics or by culture. If it's a bad business by economics, Buffett won't touch it. But if it's a good business that has just been mismanaged, so long as he can influence a new management team, he may invest to get operational control and then put the right leadership team in place to grow the company. This is known as activist investing. This differs from what we're calling overblown news causing a setback. Overblown short-term news is stories that have nothing to do with the quality of the business, or usually management's integrity. It's just a temporary setback. A great example of how Buffett uses a short-term setback to make an investment which yields huge returns is to take a look at his 1964 investment in American Express. This was amid the infamous salad oil scandal. All joking aside, the salad oil scandal was a pivotal moment in Buffett's early investment career, and it perfectly encapsulates Buffett's knack for distinguishing between temporary setbacks and fundamental business flaws. It started in 1963 when American Express was rocked by a massive financial fraud, later dubbed the salad oil scandal. The company had ventured into the field of commodity trading through a subsidiary, and by 1964, it seemed like they were sitting on a gold mine of valuable salad oil. At least that's what they thought. It turns out Amex got conned, and the tanks were actually filled with 90% water. When the scam was uncovered, American Express's stock took a nosedive as investors panicked, fearing the company's ruin. This scandal was everywhere, and the public trust in American Express was severely shaken. Now, here's where Buffett's brilliance shines through. He recognized that despite this scandal, American Express's core business, its credit and travel services, remained strong. The salad oil scandal was a huge mess, but it was a short-term issue and not a fundamental flaw in the business itself. So, what did Buffett do? He backed the truck up and went all in, of course, buying a significant stake in American Express at a deeply depressed price. He saw right past the temporary scandal to the underlying value of the company. And guess what? It paid off big time. As American Express recovered, Buffett's investment multiplied, adding a hefty sum to his portfolio. So much so that he eventually had to sell some of his Amex stock because it became over 40% of Buffett's entire portfolio. He has made tens of billions of dollars off of this trade and still holds Amex today. We talk about long-term investing all the time. Can you imagine holding a stock for 60 years? If you want to be the richest person in the world, you should start thinking like that. This episode is a classic example of Buffett's ability to separate the wheat from the chaff, to discern between a company facing a temporary crisis and one with deep-rooted problems. He understands that a good company going through a bad time can be a great investment opportunity, so long as the fundamental business remains sound. Now, back to Boeing. The question we face is this: is Boeing, like American Express during the salad oil scandal, a fundamentally strong company hit by a temporary crisis? Or are we looking at a deeper, more systemic issue that might make a turnaround way more challenging. Let's dive deeper to see if we can find our answer. Following our usual investment checklist, the first thing we want to do when we start studying a company is to understand the business. That starts with first understanding how they make money. You can look at section 1 in their annual report, but to save us all time and make this video a little more visually interesting, I created this graphic. And you can see here that they have 4 business segments, and most of them are unprofitable. This is due to Boeing being an extremely capitally intensive business. And we as investors do not like capital intensity. How you can determine capital intensity is to look at the gross profit. Gross profit is equal to the revenue minus the cost of goods sold. Your cost of goods sold are the costs associated with producing whatever good you're creating, hence the term cost of goods sold. If we log into Flank and we go into Boeing's page, and then we go to their income statement, we can see that their gross profit margin is only 5.3% in 2022, which is a very, very bad gross profit margin. And it's because of the capital intensity. It costs a lot to manufacture an airplane. Fun fact for keen users who recognize that this is 2022 earnings, Boeing will be reporting their 2023 annual report this coming Thursday, February 1st. It'll be the day after this video airs, but we'll definitely be talking about it on our Discord. So there's a link in the description below if you'd like to join. For fun, let's just compare what gross profit margin for a highly capital intensive business would be compared to a low capital intensive business. Let's look at Google, for example. So you can see that Google, who actually does have a hardware component, has a gross profit margin of 55%. This is really important. Understanding gross profit margin and margins in general is really key to identifying a durable competitive advantage. You can see that before the 737 problems that the gross profit margin was higher at Boeing, but it's too much risk for me to determine if they'll be coming back from that. Boeing also reports in its annual report that they break out their R&D expenses, and Buffett in general doesn't like companies that have to continually innovate to stay relevant. And so that's actually a negative for us. It's good for humanity, but not great for us as investors. The annual report continues on, and back orders are a big positive. There's clearly demand for their aircraft, but the market's already pricing in those back orders, so there's no upside. One thing that is fun that I just want to point out before we get off of the income statement is, since Flank is still in its alpha, I want to always double check the numbers that we present to make sure that we're reporting it right to you. And so I went in and I noticed that I was comparing our numbers to the Wall Street Journal, and I saw that Flank had it right. Flank was more correct than the Wall Street Journal in this instance. If you actually go to the source material, because the only thing audited here by the SEC is Boeing's annual report. This is as close as we can get to source data. I just thought that was really cool, and I'm really proud of what we've done at Flank. So that was just the beginning of step 1 to understand the business, but already I think that there are large problems in Boeing's fundamental business, and I also think that they have cultural issues. And so I'm very bearish on this stock. I won't be even thinking about taking a position in it, even if the company takes another 25% hit. As we saw earlier from Buffett, it's far better to buy a wonderful business at a fair price than a fair business at a wonderful price. And this business is just too capitally intensive for me, and it has too much of a customer concentration, and that's not even the recent scandals that they've had, which I think speak to the negative culture. But I also see the case that this is a business that could be considered essential to the US economy and too big to fail, given their deep ties to global transportation and the US government. So it's pretty safe to assume that Boeing's not going anywhere anytime soon. So at the right price, maybe it could be a good opportunity. Either way, I don't see it as a way to beat the market. But what do you think? I love debate, so if you disagree with me, let me know in the comments below. Before 2018 and 19, it certainly was seen as a growth stock. So maybe it still is, and I'm wrong. I'd love to hear from you. Thanks so much for watching. We'll catch you in the next one.